Hello, everyone. Really happy to be here. Thanks for attending today's webinar. Today's topic is largely around the GILTI regime that came into play at the end of 2017 and started applying to tax years for most taxpayers in 2018, 2019 for some, but mostly in calendar year 2018. And over the course of the last few years, of course, we started with flush language of a statute that said we're going to have a new taxing regime, a new anti-deferral regime for income earned by foreign corps. And then, of course, it took some time to get through regulations and to get guidance out to the public on how some of these rules should operate. And so I thought perhaps it would be a good opportunity now that we're going into filing season for 2020 tax returns to have a refresh and talk through kind of what is GILTI just at a high level, big picture. What does that mean? What does the GILTI regime do to a taxpayer? How do they comply with it? What's the calculation? So in general, what are some of the elements of the calculation that influence this GILTI calculation? And ultimately, at the end of the day, if the answer that the taxpayers seen on their tax return from GILTI is unfavorable, what can they do about it? What options do they have at the time that they file? What options do they have that they need to do pro forma to restructure maybe to avoid the GILTI regime? And so again, it'll be fairly conceptual. We'll look at when GILTI applies, we'll look at the calculation mechanics, and then talk through a lot of planning, a lot of just different techniques taxpayers can do to avoid or mitigate the tax effects of GILTI. So GILTI, it stands for Global Intangible Low-Taxed Income, really a misnomer. It isn't limited to low tax income, and it's not limited to intangible income. So the name can be misleading up front, but really what GILTI is, it's a taxing regime that taxes foreign earnings or earnings of foreign corporations. And so when you have a foreign corporation, in the good old days in 2017 and going backwards, taxpayers typically would plan into being able to defer paying US tax on the earnings of their foreign corporations. So you had a foreign corporation, maybe located in China, that was manufacturing something, producing profits, and would be able to defer, generally, paying tax on those earnings until there was an actual dividend distribution back to the US. And there was an anti-deferral regime in place before that. It was called Subpart F, and we'll talk about that just in brief in the next slide. But that was kind of the goal, was to be able to defer tax and time when we were going to pay tax in the US. Well, GILTI made that quite a bit more different. It requires US taxpayers to include in their US taxable income their pro rata share of earnings of a CFC. And it looks at that CFC, or that controlled foreign corporation, and it looks at various thresholds, and it'll say, if the CFC earns income over and above a certain threshold, then that income is deemed to be distributed in the year that it was earned. And if it's deemed to be distributed back to the US, then that's an income inclusion and a taxable event for a US taxpayer. So it really focused on foreign corporations that met a certain requirement, that were considered controlled foreign corporations. And it really looked at the earnings of those corporations and changed the timing in when a US taxpayer was required to pay tax on those. So in addition to maybe having to bring in income to the US, have a deemed inclusion back to the US, there are also a slew of other things that happen especially for US C corporations and for individuals or taxpayers who make a Code Section 962 election. There's a special deduction that can apply, and there's also foreign tax credits implications that allow a US taxpayer to claim a credit for income taxes paid by the foreign corporation. So that's kind of the big picture, the 30,000 foot view. I like to think of controlled foreign corporations in a matter of steps. And really kind of the goal has been for a long time to be able to get to deferral. Again, going back to that concept of you have a controlled foreign corporation, it's earning profits in a foreign jurisdiction. Can we time when we're going to pay tax in the US? Or given that now with US tax reform and USC corporations, if we can get through those first steps of Subpart F and GILTI and eventually get to deferral, that means for a USC corporation that it may be able to exclude that dividend distribution back to the US. It would pick it up as a dividend, but then be allowed 100% dividends received deduction. So that's very favorable to be able to have earnings in a foreign jurisdiction, pay tax in that foreign jurisdiction, and then ultimately upon distribution back to the C Corp, not have a US tax event. For individuals, if we can get through to deferral, what that means is that instead of picking up income annually under either the Subpart F regime or the GILTI regime, that means that we're not going to pay tax in the US until there's an actual distribution from the foreign corporation. And the benefit is that under Subpart F income and GILTI, under both of those regimes, the income is typically ordinary income, taxed at a maximum of 37% plus net investment tax. Whereas if it's a dividend, if we can get to deferral and have a dividend from a foreign corporation, if that foreign corporation is located in a treaty jurisdiction, then typically that dividend is eligible for qualified dividend rates or a maximum of 20%, again, plus the net investment tax. So there's a significant benefit in certain circumstances to be able to get through Subpart F, look at our foreign profit and loss statement and be able to identify the income there and say, okay, none of it is Subpart F, and then be able to get through GILTI and say, okay, none of it is going to be GILTI, and get to deferral. Potentially that means the taxpayer is going to be in a much better tax position. So when would GILTI apply? Well, we need a few things. We need to have a controlled foreign corporation. To have a controlled foreign corporation or CFC, we need to have a foreign corporation. Whether it's a corporation or a partnership or a disregarded entity sometimes isn't all that clear. Typically, the regulations look at whether the foreign entity allows limited liability to all the shareholders, and if so, then it kind of defaults to a corporation. If it's not defaulting to a corporation, potentially still be able to use a check the box selection and claim it and change it from a default classification from maybe a partnership or disregarded entity to a corporation. So once we have a foreign corporation, then it needs to be controlled by US shareholders. US shareholders is a defined term. So it's not just any US taxpayer that owns an interest in the foreign corporation. It's a US taxpayer who owns 10% or more of the foreign corporation. And 10% in this case, we would look at direct, indirect, and constructive ownership. So when we're thinking about that control requirement to get to greater than 50%, we would look at our US taxpayers that own 10% or more, and we'd add up their interests. And if combined, those 10% owners, if we get over 50%, then typically we have a controlled foreign corporation. And then we've met that requirement. Also, to be subject to GILTI, a US taxpayer would need to be one of the US shareholders. So GILTI, this anti-deferral regime where we have deemed income coming back to the US, that's only going to apply to US shareholders. So if we have one US shareholder, or if we have one US taxpayer that owns 1% in the foreign corporation, they don't meet that 10% threshold, and therefore they're not considered US shareholder, and they're not subject to the GILTI regime. The shareholder needs to own the stock on the last day of the year, really important. So if you have a taxpayer who is considered US shareholder and they sell the shares on December 27th, and the foreign year of the CFC is a calendar year, then usually what happens is the buyer is picking up that 100% of that GILTI liability for the entire year. So that can be a surprise sometimes for buyers if they buy a CFC and they own it for only a couple days and they realize that the CFC year end hasn't changed at all. It's still the same. And so they end up with the GILTI liability. And that there's some exceptions to that. There's also, for instance, if there's a 338G election that's made, which effectively ends the CFC year end, that's one of the ways to avoid that. But something that is fairly common to be discussed between the buyer and seller. Lastly, the US shareholder needs to have a pro rata share of tested income. So we've gone through all these requirements. We're a CFC, we're a US shareholder, we own the stock at the end of the year. We need to have tested income. So if If the CFC has a loss during the year and we only have one CFC that we're considering, then in that case, this deemed repatriation rule is not going to apply, because the GILTI regime really looks at income of a CFC in silos each year. So in year one, does it have income? Does it have tested income? And if the answer is yes, then that's deemed distributed back to the US. So let's go into the GILTI calculation and just what are some of those elements of this calculation that requires a US taxpayer, US shareholder to pick up income of their controlled foreign corporation on their US tax return. Well, there are a few steps. One, typically compute tested income. So, and each one of these we'll go through in a little more detail on the following slides. So we're coming up with the amount of income that's potentially subject to GILTI. Then we need to look at something called QBI. How much tangible depreciable assets do we have on the books of the foreign entity? We're going to calculate our deemed tangible income return. So that's our threshold. GILTI looks at a CFC and it says, how much income over and above a certain threshold did the CFC earn? And anything over and above that threshold is considered an income inclusion under GILTI. But anything up to that threshold is still eligible to be deferred, meaning that it's not deemed to be distributed back to the US. It can stay as earnings of the foreign corporation and then is taxable in the US when those earnings are actually distributed. Once we know our tested income and we know our floor, then we can calculate the amount of income inclusion that's going to be subject to US tax. And for US shareholders, need to aggregate all the information together from all their CFC interests. So if they have one CFC, a little more straightforward, right? They're just looking at one set of financial statements, doing one calculation for GILTI. On the other hand, if a US shareholder has several interests in CFCs, so maybe 3 CFCs, they need to take information that's related to GILTI and pull that into their US tax return and aggregate all of that to determine their ultimate or total GILTI inclusion. And the benefit with that, at least under current law, is that if we have CFC1 has income and CFC2 has a loss, the losses of CFC2, those will offset some of the income of CFC1. And so when we're aggregating everything together, we're able to look at the activity of each CFC and combine that. And that may end up with, due to losses of one CFC, it may end up with no income inclusion for GILTI for a particular year. Corps and taxpayers making a 962 election, then there's a few additional steps, calculating a foreign tax credit, calculate something called a 78 gross up, which is basically adding back the taxes that we've already deducted because we're going to claim as a credit. We can only either deduct foreign income taxes or claim as a credit. So the 78 gross up is a mechanism to accomplish that. And then for these taxpayers, they're eligible for a deduction under Code Section 250 of up to 50%. So a significant deduction on this GILTI income, for example, if there's $100 of CFC income in a year, a corporation would then pick up that $100 and then be able to claim a statutory 50% deduction. Very favorable. And as we'll see, I think in some of the numerical examples that come up, we'll see why some corporations might actually like GILTI, given that on the income that they're picking up, they're paying tax, sure, in the foreign jurisdiction, but then on the US side, they're able to claim 50% deduction. So let's go through a few of the items that affect the calculation, the tested income concept. That isn't all the income that's listed on the P&L of a CFC. We would take out certain types of income, for example, ECI, which is effectively connected income with a US trade or business. So if you had a CFC that operated in a foreign jurisdiction, but happened to also have a US branch, that type of income would be excluded from GILTI. Income that's considered subpart F. Subpart F is income that the US considers fairly easy to defer. And so it says it's just too easy to park income in a foreign corporation, and therefore you don't get deferral on this type of income. Subpart F income typically includes interest, dividends, rents, royalties, and certain related party service and product transactions. But if it is subpart F income, then it's not going to be subject to GILTI. If it could be income that's excluded from a high tax regime, which we'll talk about more when we talk about some of the developments that have come up over the last couple of years. Related party dividends, foreign oil and gas extraction income, that's all revenue streams that would be excluded from the GILTI calculation. So if a taxpayer has, or if a CFC has none of those excludable items, so all of their income is subject to GILTI, then that makes the next step, allocating and apportioning expenses, fairly straightforward because we know all of our expenses belong to our GILTI income. If some of our income was split out, or some of our income was exempt from GILTI, then we would look at our expenses and we'd need to split out those expenses and allocate those using tax principles. Really important part of that allocation is income taxes, because income taxes for certain taxpayers are eligible to be claimed as a credit. And so by ensuring that, or by calculating the amount of tested interest, or I should say, calculating the amount of taxes that are allocable to GILTI, that's a fairly important step because those taxes at some point may be used as a credit in the US. Lastly, and I would say almost most importantly, is the additional step, and this was fairly new, a new concept starting with tax reform, is the need to convert CFC income, or GILTI income specifically, from foreign book income into income that the US considers taxable income. So that basically means using tax principles that apply to US C Corps and making tax adjustments to book income, such as adjustments for meals and entertainment, adjustments for depreciation, interest expense, following accounting methods. All of those are items that now, when we look at a foreign financial statement for a CFC and we're calculating how much income is going to be deemed distributed back to the US, we need to make all the adjustments, or almost all the adjustments that we would normally make on a US C Corp return. And so that adds in a significant layer of complexity and effort to complying with the GILTI regime. So once we've gone through that first step, we've now calculated our tested income, we've converted book income to tax income. The next step is to calculate our floor. So our floor, or our threshold, is that amount that we're allowed to continue to defer. So anything over and above this threshold, we're going to deem distribute back to the US under GILTI. And so we need to calculate our QBI, which is basically our tangible depreciable assets of the foreign corporation that's used in the production of GILTI income, producing GILTI income. To do that, we need to convert the asset basis to ADS and use straight line method. And so that's typically going to slow down depreciation. And then we're required to average the assets using a quarterly, looking at the assets every quarter, the asset basis each quarter, and then averaging it out for the year. And if we had different types of income, so again, if we had some income that was excluded from GILTI and some that was included in GILTI, then we would need to separate out those assets. But if we have kind of the base case, just one CFC, all it's doing is producing GILTI, then all of the assets are held in the production of GILTI income. Once we know our QBI, then we take that, multiply it times 10%, and that gives us kind of our initial floor, but we have to adjust that floor by interest expense, and that's net interest expense, considering interest income and interest expense. And so we have our QBI, we multiply it times 10%, that gives us a result. But if we have interest expense, then we have to lower that threshold a little more. And so potentially taxpayers that have large amounts of deductible interest expense, that may mean that their threshold is significantly reduced. And if their threshold is significantly reduced, then that means more GILTI income is going to be included on their US tax return. Again, a few additional steps for C Corps and taxpayers making this 962 election, which eventually we'll get to and we'll talk through. We'll have that 78 gross up. We'll be able to have a 250 deduction, or that 50% deduction. That's up to 50%. And the reason I say up to is that it's contingent on taxable income. And so there's an interplay between GILTI and taxable income there. Foreign tax credits. The interesting thing about GILTI is that as a result of tax reform, additional baskets were created for foreign tax credit purposes. So in foreign tax credit world, there's different baskets, and those are really designed to limit a taxpayer's ability to claim credits in one basket against US tax that applies that's being assessed to income in another basket. And so we have a general basket, we have passive income basket, we now have a branch basket, and we also have a GILTI basket. The other branch, the other baskets such as general and passive and the branch, those have the benefit of if there are taxes in those baskets that are not used in a current year, those can be carried back 1 year or carried forward 10 years. With GILTI, it's a little different. There is no carrying back taxes to a prior year or carrying it forward to a future year. So GILTI really looks at the activity in a single year. And if a taxpayer had significant foreign taxes, that when they go through their foreign tax credit calculation, if they're unable to use all of those foreign taxes, then that means that those taxes are basically wasted. They're unable to carry them back or carry them forward to a future year and utilize them in the future. And that's a significant limitation to the GILTI calculation. So let's look at an example. This example has a US corporation and a US individual. It's the same numbers, but this illustrates what happens with a corporation versus an individual. So if we start on the left with a corporation, we have $1 million of income and a foreign tax rate of 15%, so $150,000 of tax. We net that down to 850, and that would be our tested income, assuming that that's based on US tax principles. The next step is we need to calculate our floor. So in this case, we've assumed that QBI times 10% less the interest expense equals $100,000. And then so that's our floor. And so when we take our tested income of 850,000 less our floor of 100, that gets us to 750,000 of a GILTI inclusion. For corporations, and we'll see this eventually as well with taxpayers that make a 962 election, there's an extra step. Need to calculate the amount of foreign taxes, so the amount of that 150,000 tax that's attributable to our $750,000 of income inclusion. And so that's what we've done there to calculate the 88.24%. At that point, is we just continue going down the math. We start with 150,000. We want to figure out how much of that is related to GILTI. Well, it's the 88%, so that gets us to 132,000. And the math starts breaking down there and isn't quite so round and pretty. But the other step for foreign tax credits is that the taxpayer is only able to claim 80% of the foreign taxes as a credit. So we start with that 132 number, but we're limited to 80% of that, or 105,000 in this case. So now we know our GILTI inclusion, we know our foreign taxes. The next step would be to calculate our full inclusion using the 78 gross up. And in this case, the 78 gross up is the full 132,000 of taxes, so not just the 105. So we start with 750,000 of income inclusion, and we're going to add back the taxes, and we're adding back the full 132,000. We're able to claim a 50% deduction, no taxable income limitation here. And if we follow through the math there, we get to a US tax liability of 92,000. But note that we have 105,000 of foreign taxes that we can claim as a credit. So no US tax liability as a result of GILTI for the US corporation. And note that there's 105,000 of foreign taxes we could have claimed as a credit if we would have had that much of US tax. We only had around 92. So that means there's around 13,000 of foreign taxes that, again, because in our baskets, we can't carry that back or carry it forward, that's just lost. So at the end of the day, we paid tax of 150,000 in the foreign jurisdiction, and in the US C corporation model, we had no additional US tax. On the individual side, it's a little different story. If it's the same 750,000 we pick up, individuals absent any other elections, they're ineligible to claim a credit for that 150,000. So they're just kind of stuck with the $750,000 income inclusion. That's all ordinary income subject to a tax rate of 40.8%. So they incur an additional 306,000 of tax. So that's a considerable hit for an individual. They've not only paid 150,000 of foreign taxes, they've now incurred 306,000 of US tax. And this is all deemed distribution income, or income that's deemed distributed. There may not have been any cash transfers. And the other thing is the individual, they may have planned for their CFC to continue to increase R&D, for example, or continue to expand outside the US. And so the goal may not have been for cash to come back to the US to pay for taxes. The goal may have been to continue to develop their foreign operations. And obviously, throwing in a $300,000 liability can significantly alter their plans. One other thing I want to mention, just on the US corporation side, notice that in this case, the global tax liability on the GILTI income is 150,000. If the US corporation had just earned that $100,000 directly, or that $1 million of income directly, typically it would have been subject to a 21% tax rate and paid 21% tax. And so as a result of the GILTI regime and that 50% deduction, in certain circumstances, it may actually be more favorable for a foreign corporation to set up a foreign sub and then operate its activity through that foreign subsidiary rather than paying the full 21% tax here in the US on that income. So what happens, I mean, aside from the taxes that come up, what happens to a corporation or individual when they have GILTI? Like what's the residual effect of that? Well, they've picked up income that's deemed distributed. So what happens is that the taxpayer increases their basis in the stock of the foreign corporation. And that corporation sets up an account called a previously taxed earnings and profits account. And basically what that is it's earnings that's set aside and designated as previously taxed in the US. And so eventually when the taxpayer or when the CFC distributes the cash, the taxpayer will not pay tax again on that GILTI income since they've already done it once. So that'll have the effect of reducing the shareholders' basis back down for cash that they received. And if the foreign corporation or the foreign jurisdiction, I should say, incurs or assesses withholding tax on that income, then at that point, there may be an opportunity to claim a foreign tax credit for the withholding tax administered by the foreign jurisdiction. Because the foreign jurisdiction likely doesn't care that the US has a GILTI regime. So if there's a distribution of profits, they may assess the classical withholding tax. So let's get into some of the guidance that's come out as a result of tax reform. There's a lot of detail, no doubt, that's come out over the last few years. Even just in 2020, saw a lot of guidance that was really helpful related to foreign tax credits. As far as GILTI goes, there were a couple items that came out in 2019 and 2020 that I thought would be worth mentioning. One is how partnerships and S-corps handle the GILTI tax regime, specifically the income inclusion. Prior to tax reform, I should say, when a partnership owned 10% or more of a controlled foreign corporation, the partnership itself was considered a US shareholder. So what that meant is if under the older and still in existence Subpart F regime, if there was a deemed income inclusion, the partnership would pick up that income on its return and flow it through to all the partners, regardless of whether the partners owned 10%, 5%, point something percent. The partnership, the key there was that the partnership was the 10% owner. The US changed that, Treasury changed that in 2019, especially for GILTI, as they were thinking through how GILTI should be calculated. And instead of the partnership or the S Corp looking at its interest and saying, do I have a 10% ownership or not? And if so, and picking up, then I'm going to pick up all the income. Instead, we really just look through the partnership or the S Corp. And so the information flows through down to the partner or S Corp shareholder level, and then the partner or shareholder, they decide or determine whether they're a US shareholder in the CFC. So they would look through their partnership interest and they would say, do I own 10% or more? And if they do, then they're subject to the GILTI regime. And if they're not, then typically they would be exempt from it. One of the significant considerations related to partners is that they may be related with other partners. And so it's not enough just to look at the partnership ownership percentage and calculate it, do the math and say, oh, do I own 10% or more? You may have to look at the other partners and say, well, am I related to partner A or partner B or C? And if so, how much do they own? And then calculate that all together. I included one other slide. We're not going to go through it, but I wanted to include it just so you're aware of the potential implications of special rules the US has for constructive ownership related to CFCs. Take a look at that one. It produces an interesting result in that shareholder or partner A, who is a 10% owner in PRS1 and who seems like, if you do the math, only owns 9% of CFC. Under the US rules, A is considered a US shareholder, and A would be subject to the GILTI tax regime. Fairly strange result, or I guess not a logical result, but has come up, and I've seen it a couple times in practice here at Eide Bailly. So let's move on to the high tax exclusion. This was very helpful, something widely anticipated in the world of GILTI, and it came through as final in 2020. I think it came through as proposed in 2019. And the high tax exclusion, what it does is it says, if you have a CFC and if it's earning income that's over and above, or it's paying tax that's over and above a certain amount, a certain rate, then that income is going to be considered high tax. And if it's high tax, then it's eligible to continue to be deferred. In other words, we're not going to deem that income to be distributed back to the US, or we're not going to require you to pick that up as part of your GILTI and run it through the GILTI calc. And so that rate, that threshold is 90% of the top corporate US tax rate, which 90% of 21% at the moment is 18.9%. So the foreign tax rate, the effective foreign tax rate on the income of the CFC needs to be in excess of 18.9%. So there's a couple neighboring countries to the US, Canada, I think is at 25, maybe 27, 28%. That would typically be eligible. Mexico's at 30%. And so every country that has a tax rate that's over and above that 18.9%, it's possible that this high tax exclusion could apply. And we'll talk through why I say it's possible. We still need to go through the analysis and the math and make sure that when we do our calculation, we're over and above that 18.9%. The high tax exclusion, it looks at tested units of a CFC. So in a base case, if you have a CFC that's located in China and just doing manufacturing in China, then we'd just be looking at that income and the expenses allocable to that income and the tax rate, the effective tax rate to that income. On the other hand, if we had a company in Germany, and that German company not only had activity in Germany, but had a branch in France, owned a partnership interest in Turkey, we need to look at some of those revenue streams a little closer and determine the effective tax rate of each of those revenue streams. So not only what's going on in Germany, but also what's going on in France and what's going on in Turkey, and look at those income streams independently and see whether those meet this 18.9%. One of the impacts of the high tax exclusion is that not only does it exclude the income from coming back and making its way into a taxpayer's GILTI calculation, but it also excludes some of the other elements like the QBI amount or the foreign tax amount. And that can be a significant effect, can have a significant effect on a taxpayer. In a base case where there's one CFC, not much of an impact. If we know we qualify for the high tax exclusion, then we can kind of isolate our analysis just to that entity. On the other hand, if we have two CFCs, one's located in a high tax jurisdiction, maybe like Canada, and the other is located in a low tax jurisdiction or no tax, like the Cayman Islands, then we may want the foreign taxes, not only the income that's generated in Canada, we may want that to come into our GILTI calculation, because although we pick up the income, we also pick up the foreign taxes that were paid in Canada. And the benefit there is that since we're picking up income from the Cayman Islands that has a zero tax rate, we can use some of those taxes in Canada to claim a credit against the US tax that's assessed against the Cayman Island income. And so, but if we exclude all of our Canadian income, in my example, that means we're picking up a bunch of Cayman Island income and we don't have any foreign taxes to claim as a credit. So the point there is that if there are several CFCs involved, it's worth looking through or doing a model potentially to see what the overall tax impact is. The election is annual. It can be done on amended return. Very helpful. Some of the proposed rules talked about locking in taxpayers for a certain time period. The election is binding on all US shareholders and is made by the controlling shareholder. So if I own 10% of a CFC and a US company owns 90% of that CFC, the US company would be the one that makes that decision, and me as a 10% owner, I just deal with the decision that's made by the controlling shareholder. If the controlling shareholder does make the election, they need to give notice naturally to the other shareholders so they know what they need to do on their tax return. The election is a statement included in the return or an amended return. I also want to mention that on amended returns, one of the changes in the final regulations was that the high tax election is able to be made going backward. So going back, it applies to 2018. So very helpful. But in addition, there's a 24-month window to claim that election. So for tax returns filed in 2018 for an individual or maybe a C Corp that had a due date of April 15th of 2019, the clock is ticking because that 24-month window ends April 15th of 2021. And so in order to go back and to make that election for 2018, returns need to be amended before April 15th of 2021. And in addition, if there are several shareholders that need to amend their returns, they all need to do that within a 6-month window, which is, I guess, convenient for the IRS to process them faster. And all of that needs to be done before that 24-month window. So there is some timing to work through, especially if it's going to be amended. Obviously, if it's a timely filed election, then we don't wrestle with those timeframes. So let's walk through just kind of in general what the calculation looks like, and then let's look at a numerical example because I think that will help. And the numerical example is more of looking at the tax effects of a high tax exclusion. So one, we'd calculate or determine our tested units. So again, in the base case, if we just have one CFC, that's fairly straightforward. One CFC, and if they're only doing their activity, again, I'll go back to a German example. If everything's in Germany, then that's fairly straightforward. Calculate tested income and the deductions that are related to it. Need to calculate the amount of income that's allocable or the amount of income tax that's allocable to that income. And from there, we can do a simple ratio of our foreign taxes that are attributable to our income and then over our income, and that should give us a ratio. And if it's over 18.9%, then we're eligible to claim the high tax exclusion. So let's look at what that might do to a taxpayer that makes that election. So on the left, we have the corporation. On the right, we have the individual. And let's say we have $1 million of foreign income, and we're going to make that high tax exception or the high tax election. So in this case, we don't have any, we're not going to pick up any of the income as GILTI. So that's great. For the US corporation, that means that since we don't have GILTI, that the income is eligible to be deferred. So USC corporation then can continue to defer paying US tax on that income until it's actually distributed. The benefit for a USC corporation is when that income is actually distributed, it's generally eligible for a 245 Cap A deduction, which is the 100% dividends received deduction. So big benefit there for a USC corporation in that it hasn't paid tax, it only pays tax in the foreign jurisdiction, and then it's able to defer paying tax in the US until there's a distribution. And for federal tax purposes, it's able to really exclude all of that dividend income. States may differ, so there may be a state tax liability, but from a federal perspective, the income's excluded. So at the end of the day, on the US corporation side, just paying tax in the foreign jurisdiction, so 20% effective tax rate. If we look at the individual side, the benefit of the deferral is that, again, they can time it for when they want to pay tax in the US on that distribution. And if that foreign corporation is located in a treaty jurisdiction, such as Germany, then that distribution is typically eligible for qualified dividend rates. So that would mean a max rate of 23.8% in this case, or $190,000 liability. On the other hand, if that CFC was located in a non-treaty jurisdiction, then typically that distribution is going to be a non-qualified dividend, and it's subject to ordinary tax rates rather than qualified tax rates. So that's a significant consideration for an individual when they're bringing back that cash. Another thing I suppose worth mentioning is on the U.S. corporation side, if the income is ultimately going to be distributed to the individual shareholders, then likely we're in a very similar situation as the illustration on the right with just the individual, because we pay no tax at the corporate level due to our dividends received deduction, but then upon distribution, it would likely be a qualified dividend to the individual. So throughout I think more towards the beginning of the presentation, I mentioned something called a 962 election. And that election is for individuals, trusts, and estates that would like to tax their deemed income from a CFC differently than just picking it up as ordinary income in the year that it's earned. And so what the 962 election does is it allows a taxpayer to fictionally have a C corp between them and their CFC. And so in the year that there's GILTI income, the flow is to their pretend C corporation first, which the benefit there is that the GILTI income goes to the pretend C corporation, but the C corporation can claim a 50% deduction, can claim credits for income taxes paid in a foreign jurisdiction, and applies the 21% rate. And so that can be very effective and very useful for taxpayers. And the benefit is that it requires no structuring. Typically, it requires no restructuring and can be made at the time that the tax return is filed. So it's not something that needs to be done prospectively. It can be done at the time that the taxpayer is looking at their tax situation. And we'll go through a numerical example of why this might be beneficial and in certain cases why it might not. But the general effects are that instead of getting that basis step up in CFC stock, like they would for if they had GILTI and they didn't make a 962 election, typically, they're picking up the GILTI income and their basis is being increased in that CFC stock. If they make the 962 election, they are introducing a second layer of tax because they are kind of pretending that they have a C corporation in between them and the foreign corporation. So they get no basis in that foreign corporation distribution, or no additional basis, I should say, as a result of GILTI. Distributions are generally taxable. And whether the distribution from the foreign corporation is ordinary or qualified is dependent, again, on whether that foreign jurisdiction, whether that CFC is located in a foreign jurisdiction. And one other item I think probably worth highlighting here is point number 6, is that 962 is kind of a rare thing. Well, it was kind of rare until GILTI came around, then it became popular. And states don't have a lot of great guidance on how to handle 962 elections. So I think some states, they look at it and say, if they conform to GILTI, first of all, that's probably the first step. And if the state conforms to GILTI, then the question is, well, does it conform to 962? And it seems like states are saying that they just ignore the 962 election. That's just something that a taxpayer does on the side on their federal return. But there's not a lot of great guidance. Not a lot of states have come out and specifically said how they approach a 962 election. I think one did. Georgia might have been the state. So let's look at what this might look like from a mathematical perspective for individuals. We have 3 examples here. It's the same income inclusion or same GILTI number. On the left, we have the 962 election with qualified dividend. The middle is a 962 election with no qualified dividend. And the right, it's GILTI without a 962 election. So if we start on the left, we have our $1 million. We'll flow that through. In this case, we're going to assume there's no DTIR. So the full million is going to be picked up as GILTI income. We get our 50% deduction because, again, the individual's pretending that they have a USC Corp between them and the CFC. So their corporate tax rate or their corporate tax liability is $105,000 before applying any foreign tax credits. Since they are a C Corp, fictionally, for a 962, they're able to claim 80% of the foreign taxes as a credit. So we take the 150,000, multiply that times 80%, and that gets us to 120,000. In this case, our foreign taxes are more. than our US tax liability at our fictional corporate level. So we pay no additional tax as a result of making the 962 election. So the big benefit in this case would be that if a taxpayer wanted to continue to defer paying US tax on their GILTI income, they could make a 962 election, and in this case, they wouldn't have that first layer of tax. Ultimately, when they distribute the earnings, the $850,000 of earnings, as is evident as we keep flowing through the example, that comes through as a dividend, and then that's subject to dividend tax. Again, if the CFC is located in a treaty jurisdiction, typically eligible for that qualified dividend rate. So let's look at what that looks like in the middle column, where the distribution is from a company that's not located in a treaty jurisdiction. In this case, the tax rate would be ordinary rates, would be 37% plus NIT, so we'd get to 40.8%. And so there, just in those two examples, we can see there's a significant difference in tax, and it's solely dependent on where the CFC is set up. But also in both examples, both of those two examples, the first one and the second one, the benefit there for the taxpayer is deferral. They can time when they want to distribute that 850,000 and pay tax in the US. Lastly, without the election, that's just going to have GILTI flowing through. Again, that's at ordinary tax rates, and the tax effect is the same as that middle column of a distribution of ordinary income. The difference between the middle column and that last one without the election is that without the election, the GILTI flows through in the current year. And so that's taxable in the year that there's GILTI, whereas in that middle column, we have no additional tax liability as a result of GILTI, and we only have a tax liability upon actually distributing the earnings. So what if a taxpayer was in a situation where they had a CFC set up in a foreign jurisdiction, and that foreign jurisdiction did not have a treaty with the US? So on one hand, they like the benefit of that middle column getting deferral. On the other hand, they don't like the tax effect of a distribution being subject to ordinary tax rates. And so one of the planning ideas is to set up an actual US holding corporation. And the benefit there is that the USC corporation still gets the benefits, just like our 962 election. It's still going to pick up the income as GILTI each year. It's going to get a 50% deduction. It's going to claim foreign taxes as a credit. The other benefit is that when the cash is actually distributed from the CFC ultimately to the hold company, that should be previously taxed earnings, so not taxable again. And ultimately, when the US holding company or USC Corp distributes the cash to the individual, then generally that's considered a qualified dividend since it's a distribution from a US company. And so that's a fairly effective way to convert that ordinary income dividend or that dividend from ordinary income to qualified dividend rates. So what are some other ideas for planning related to GILTI? Well, it's kind of two schools of thought. One is just avoid GILTI altogether, or two, attempt to mitigate it. And mitigating it to me is more adjusting the calculation, the elements of the calculation. Avoiding it is removing the CFC classification or the US shareholder classification altogether, or getting out of the investment if that's possible. To avoid it, one idea is to change the CFC classification from a CFC, so from a controlled foreign corporation, to something else like a partnership or a disregarded entity. And the benefit there is that we remove some of the limitations with GILTI. For instance, GILTI looks at income in silos. And so if in year one, the CFC has losses, and in year two, it has income, for GILTI purposes, the losses in year one are ineligible to offset the income in year two. And so we're just looking at year two in a silo, and we need to pick that up as GILTI if, as a result of the calculation, we have a GILTI inclusion. On the other hand, if we had a partnership or a flow through, like a disregarded entity, those losses in year one typically would flow back, and we can claim those as a loss. And then in year two, we would have income, but overall, we've kind of evened out since we had our losses in year one that flowed through. So that's fairly effective. The other thing for individuals, without a 962 election, recall that the income taxes paid by the foreign corporation, those are ineligible to be claimed as a credit. So one way to avoid that is to treat it as a flow through. That means that all the income is going to flow through, but also the income taxes paid in the foreign jurisdiction also flow through and are eligible to be claimed as a credit by the individual shareholder. So that's fairly beneficial. And that's one of the structures, and we'll look at that on the next slide, just an example of what that looks like. The flow through model is kind of the alternative. If we look at GILTI and we don't like the result, introducing a holding company, sometimes we run into state tax issues. Maybe we don't like that result. 962 doesn't work. Maybe it's best just to change the classification and just treat it as a flow through entity. Can also insert the C corporation. I think we walked through that in the prior slide. Ways to mitigate GILTI would again be to affect the calculation. Change Q by, adjust Q by, mainly increase Q by. So if an entity could take on more manufacturing, could have more assets, that would be one way to do it, because if we have more Q by, that would raise our floor. And let's see, if a CFC has a loss, and it also incurs foreign taxes for some reason, those taxes don't flow back into our calculation and are ineligible to be claimed as a foreign tax credit, for example, in a 962 election or in a C Corp example. So if there is a foreign entity that for some reason is paying taxes and has losses, one idea is to try to increase that activity so they actually are producing income. And if they're producing income, then those taxes flow back and can be used as a credit in the calculation. And I think that's just a technical item within the calculation. Reduce interest expense, obviously that'll reduce our floor, that'll change our floor and would increase our floor using the high tax exception or the 962 election. And I think to round out the presentation, just to show the difference here, this is the difference between the flow-through model. We've looked at a couple others where there was GILTI, and we'll see on the left-hand side where we have the US corporation, all the income of the foreign activity flows through. So we pick up the full million and then we subject it to 21% tax. We claim a 50%, or we don't get the 50% deduction because it's not GILTI, but we are able to claim a credit for the 150,000. So we're left over with 60,000 of tax on the corporate side. So at the end of the day, we end up with a 21% effective tax rate on that income. And in this simplified example, we're not including the FDII deduction, which could apply if the foreign corporation were selling abroad. But I think what this does is show the difference that I think if I recall correct, if all the income was GILTI, then we had no additional US tax liability for the corporation. Whereas if the corporation is operating abroad directly without a CFC structure, then it is incurring additional tax here in the US. On the individual side, that shows the benefit of having it as a flow through in that the full $150,000 of foreign income taxes, those flow through and typically can be claimed as a credit on the tax return. And with that, I think that wraps up our presentation for the day, just before 1 o'clock my time, Central Time. So Amy, we can either open it up for questions.
Sure.
Or if there's any other admin items, take care of those.
Yep. So first question here is, will the GILTI increase S Corp shareholders basis?
I think there's been some activity around that, not on the S Corp side, not only for AAA accounts and how to account for those, but also in the partnership and the S Corp structure. At what point does the partnership get to increase its basis in the CFC, and at what point does the shareholder, the S Corp shareholder, or the partnership partner get to increase its basis in the partnership? And I don't know if there's been a resolution on that. I think there's been a couple approaches that have been suggested, but if you're willing to send me that question in an email, I can take a closer look at it and see if something has been finalized, or the Treasury has a position on it.
Awesome. Well, that's actually the only question that came in. So I believe We are good to go. So thank you all so much for attending. Thank you, Aaron, for presenting, and we'll give everyone back 2 minutes of their day. So have a good one, guys.
Awesome. Thanks, everyone. Take care. Thanks, Amy.